Hello, my name is Jayson. I'm with Chegg Tutors. Link to my profile is down below right here. Today we're going to be talking about cost of goods sold. Cost of goods sold in terms of a merchandiser, i.e. someone who buys and resells goods rather than making them themselves, isn't too complicated. For instance, if we have X company and they buy 100 t-shirts for $10 each, then our inventory, which is a balance sheet item, increases by 10 times 100 or $1,000. If we then sell 20 of those t-shirts, our inventory decreases to 80 t-shirts at $10, and our cost of goods sold, an income statement item, would increase by $200. So the journal entry to record this would be to debit cost of goods sold by $200 and credit inventory by $200. Now, if we're talking about a manufacturer rather than a merchandiser, a manufacturer being someone who makes the parts himself rather than purchasing them, the cost of goods sold is three components combined. It's direct labor, direct materials, and overhead. Direct labor is pretty straightforward. If someone works an hour on a part and we know the labor cost is $20 per hour, we can easily figure out the direct labor cost. Likewise with direct materials, if we use a pound of direct materials and it's $20 per pound, we can easily figure out our direct materials cost. Overhead is a little trickier. Overhead used to be a bunch of tiny costs that people didn't want to bother separately accounting for. So if we were using oil, a drop of oil on a part, if we were cleaning it with some Windex or whatever it might be, if we had some depreciation on factory equipment, if we had some factory supervision expenses, if we had some factory janitorial work, and we didn't want to allocate each of those individually, what we would do is we would put it in a cost pool, and then we would allocate that cost pool based on some activity base. It could be direct materials, direct labor, machine hours. There's a lot of different potential ways you can allocate that. And it used to be overhead was just a very tiny component of the overall product cost, and that's why people would just lump a bunch of stuff together and allocate it randomly, depending on how they wanted to allocate it. They could do it any way they wanted to, which created problems later in time when overhead started becoming bigger and bigger. But for the most part, you can just allocate overhead how you like, based on direct materials, direct labor. So for instance, if we had factory supervision, we had janitorial work, we had oil for the part, we could lump all that together, and let's say it cost us $10 per machine hour, and we know it takes 1/10 of an hour per part. Our total overhead cost would be $1 in that case. So when we combine that with our direct materials and direct labor, our total labor cost would be $41. So every part we make, our cost of goods sold income statement account would increase by $41, and our inventory balance sheet account would decrease by $41. And that's the basics of cost of goods sold. If you have any questions, my profile link is below. Have a good day.